We will now look at how to enter data on the Machinery Equipment worksheet. Machinery includes pretty much everything that is used in a farming operation: combines, tractors, seeders, shop tools, and computers. Everything that is normally used for more than 1 year. Make sure all the machinery and equipment is included. Missing information will affect the quality of the economic analysis. This data will also be used in generating cost of production summaries of farm enterprises, budget sheets, and economic performance indicators. The Machinery Equipment worksheet is one of the key data entry worksheets in the AgriProfit's Accrual Adjusted Cost of Production framework. Because the costs are calculated differently for owned and leased machinery, you need to enter that information separately into 2 different tables, as shown here. Where can you find the machinery data? There are several possible sources. First, look for the fixed assets listing that is normally prepared by accountants. Other sources include Farm Appraiser certification that lists the assets along with evaluated market values. Also, assets insurance listing, or statement of assets and liabilities as provided to lenders. For leased machinery, the assets lease agreement is a good source of data. Now let's take a look at the leased machinery table. Just like for owned machinery, the leased machinery table can be divided into 2 parts. A description of the leased equipment, in particular the total leased amount and the start and end dates for the lease, and allocation of the payments among farm enterprises. Let's learn how to enter the machinery data into AgriProfits, starting with owned machinery. By function, the table is divided into 2 parts. First, machinery description and cost information. Then, allocating the cost among different enterprises, like cereals, forages, cow-calf, other enterprises, and non-farm and personal purposes. Assuming you have the machinery inventory listing in front of you, let's look at the example highlighted in gray. Suppose the producer has a 2-wheel drive tractor with a current market value of $35,000. Choose the appropriate type of tractor from the drop-down list. Enter $35,000 as the current market value. Next, allocate this cost to the enterprises where the tractor was used in a specific fiscal year. In our example, let's assume that 40% of the time the tractor was used for forages, 40% for pasture, and 20% for the cow-calf enterprise. What if the current market value for this tractor is not available? We need to use the original purchase price and the year the tractor was purchased or manufactured. Let's assume the original price was $50,000 and the tractor was purchased in 2010. AgriProfits will automatically calculate the book value of the tractor and will use it to calculate the depreciation cost. Remember to record all sales, trades, and purchases made within the production year in the Purchased Sold cell of this worksheet. For machinery equipment sold in the fiscal year, enter Sold. For machinery equipment purchased in the fiscal year, enter Purchased. This helps keep your machinery equipment listing up to date and calculates depreciation on the units sold and purchased according to standard rules and according to Canada Revenue Agency rules to apportion depreciation to that year. Any machinery equipment purchased in the production year must also be entered on the liability worksheet. If you have participated in the program in the previous year, unless otherwise indicated, the machinery equipment list on file will be depreciated according to standard rates into the next year. Now to the leased machinery equipment worksheet. You do not need to choose a specific type of machinery. Instead, indicate the class of the equipment that reflects dryland or irrigated machinery, and also whether the machinery is self-propelled or pull type. These distinctions are important for the calculation of machinery costs. Now let's look at an example on the leased machinery table. Suppose a producer leases a two-wheel drive tractor with a total payment of $42,000, and the lease started in 2012 and ended in 2017. In our case, we choose the self-propelled type of equipment, then enter the total lease payment, $42,000, 2012 as the start year, and 2017 as the end year. AgriProfits will automatically calculate the annual lease payment, $7,000, that has to be allocated to farm enterprises. Let's assume the tractor was used 50% of the time for cereal crop production, 45% of the time for forage production, and 5% for pastures. The information must be entered separately for each type of leased machinery, line by line. This ends this module. Remember to save your data frequently as you move through the worksheets. If you have more questions, refer to the AgriProfits Help tab, AgriProfits Data Entry Help Manual, or ask AgriProfits staff for help.